All right, I think it is now 12:30. Good afternoon, everyone, and welcome to this BFM Personal Finance webinar in collaboration with the Financial Planning Association of Malaysia. My name is Roshan, and co-moderating this discussion with me today is Malek Ali, founder of filife and BFM Radio. Having this discussion with us, the stars of today's show, Linnet Lee, CEO of FPAM, and Rajen Devadason, CEO of RD Wealth Creation. Now today, we're taking a look at one particular question. What would you do differently with your money as we come out of the MCO? I think really the tone of this is that many people have been impacted by the MCO in varying degrees. Many people have lost incomes, and really it's about kind of figuring out how to take the next steps forward and learning from this. So Rajen, Linnet, Malek, good afternoon to all of you.
Hi Roshan, good to see you.
Good afternoon.
So let's just get into some of the main points here, right? When it comes to any of our personal finances, one of the most important things is our lifestyle. It directly plays into how much we spend, how much we can save, and how much we earn. Linnet, could you maybe kick us off here about the importance of taking a look at our lifestyle and what we can learn out of the MCO so that we're better prepared for the next time something like this should happen?
Thank you, Roshan. And you would see that a lot of people have actually made a lot of changes in their lifestyle. For one, people are more health conscious than they have been before, but in part because they are unable to go out. Therefore, they will then take care of their health better, because these are things that they've always wanted to do, but they've never found time, or there's always something else to distract them. Other things that I noticed that has come about with this change is also the ability to spend more time with the family. A very quick check with people that I know, they have told me that one of the things that they learned from the MCO is to be patient with the family, because in the past you go out to work, you don't spend time with your family, it is easier. But when you have to spend 24/7 with your family during the MCO, they learn to know their family members better. They learn that there are things that they need to do to be more patient. I would think that, and I like to think that this has actually made families more cohesive, and that's very important, because one of the things that I was most worried about is the unraveling of the family fabric. And what has that got to do with finances? A lot, because a happy family would mean that staff will be happier, they'll be happy to work, they're more productive at work. So I think these are good things that have come out from the lifestyle change. And socializing, people are beginning to learn how to socialize through Facebook, chats, Zoom, and they realize how important it is. So I would like to think that there are good things that come out of the MCO, but there are also not so good things, like for example, people losing jobs, people having to change the way they work. They may need to reskill themselves because certain jobs are no longer in demand. So a lot of this actually has a large impact on how we manage our finances, because what we do will then decide. I know people don't go to gym, but they can look after themselves and do exercises at home, because they learned that during the MCO. So, and the other thing that we also realize is people are shopping online rather than lining up, taking temperature, writing their names, and being exposed to people who are not mindful of physical distancing in the shops. So these are things that we see that is making a huge change in everyone's life. And it's not just in Malaysia, but it's global as well.
Yeah, Linda, I think these are things that happen during the MCO, right? So whether these habits continue or not, that's, I think, going to be very telling. And we really don't know how this plays out going forward. But one of the things, just following on that point there, is that it really comes down to spending. We're seeing most expenditure online. I think one of the data points was Shopify was showing, I think, Black Friday levels of expenditure in January, in February and March, which is incredible, right? That's how much e-commerce was flowing through their system. Rajen, what points do you have here in terms of the lifestyle changes that not just have happened, but in terms of personal finance, what you'd like to see happen?
Thanks, Roshan. Just to riff off what Linet's spoken about, I think one of the best gains that almost all of us have had throughout this very difficult MCO lockdown period, circuit breaker, depending on where you are, is that not everyone, but the vast majority of us are now spending less. And the more locked down we were, the less we were actually spending. Now, for those of us fortunate enough to have retained our businesses, retained our jobs, and those employees who were actually able to sustain their income, that means there were no cuts whatsoever. The equations of financial planning are incredibly simple. There are two primary statements. One is the net worth statement, which lists your assets and liabilities. But the one I'm going to focus on now is actually your cash flow statement, which effectively lists your cash inflow and your cash outflow. So for those people who did not suffer any kind of hurt income, cash inflow would have been the same. If you can't go out and you can't spend as much money, then your expenditures actually drop, which actually raises your surplus. Now, this is primary school math, okay? But to be able to apply it is actually the mark of someone who's got common sense. And common sense, unfortunately, in this day and age is incredibly uncommon in terms of practice. So I think for the vast majority of people who've been able to hang on to their income, who have reduced their expenditures, have raised their surpluses, what they want to do is to try and hang on to the gains that they have already secured. And it's not going to be easy because all of us have got very, very short-term memories. There is another group where expenditures actually gone up. And these are the people who I think in general didn't spend a great deal to begin with, but being cooped up at home, they discovered the power of the internet and the efficacy of a mouse. And so the ability to just keep clicking has resulted in a massive surge in e-commerce. And so those people who are now spending more during a period when the vast majority of us were spending less, I'm sure the e-commerce retailers are going to be very, very happy with them. But this does not augur well for them because they may actually have engendered appetites that they're going to have real trouble curbing later. So I do want to focus on the majority of people. Spend less or spent less during the MCO. And then as we begin to move into a period of being freed up, there will be two distinct groups. There will be one group that says, you know, I've actually made real gains. And if I'm able to hang on to at least some of these gains over the years ahead, my family's financial life will be better because I have discovered that I need less to live on than I thought that I did before. And there will be others who, you know, enjoy the short season of spending less, and then they'll very, very quickly revert to the norm, and they're going to go back to spending. But the thing you have to understand is that the global economy is going to take at least a year, maybe two, to be able to start clambering out of this hole that we're in. You look at the inherent strength in the capital markets right now, and you understand that there is a massive disconnect between Wall Street and Main Street, mainly driven by the printing of money. And so money has basically flowed into the investment markets. The anticipation is, yes, of course, we know this crisis will pass, but I think the world needs to take a beat and to realize, you know, there's been massive devastation. Entire industries have been created. And I think it will actually be healthy for the markets of the world to come crashing down for a little while. For those of us who've actually exercised a great deal of restraint, have actually built up cash, we're hoping for that kind of dip. Whether it comes or not, I don't know. But I do know that in the days ahead with regard to financial behavior, there are tremendous opportunities for people who extract the correct lessons to actually prosper and to become so much wealthier as we move into a time of recovery in the next 1 or 2 years, as we go into a time of strength, economic strength. And if we are able to position ourselves correctly for the next crisis, we could end up very wealthy.
Yeah, Rajen, I think we'll be getting into investments also a little bit in about, I think, 10 minutes, 10, 15 minutes, we'll dive into that a little deeper, especially as interest rates have been cut. But one of the things when we look at cash flow management, and in fact, interest rates, actually, if you really think about it, is savings, right? It is really, some people have seen their cash flow statements, maybe have been able to pull in more savings over the last few months and hopefully build up those reserves that I think we talk about quite a lot, but it's actually very hard. It has been very hard for many Malaysians to build up those reserves. I think I saw a survey recently where some even struggled to get 1,000 ringgit in cash reserves. And that's a significant problem to have. And in fact, this morning we ran the loan moratorium was one of those ways to help with cash flow. And this morning on BFM, we ran a survey and a majority were asking for it to be extended, right? So 34% asking for it to be extended but targeted, and the 42% asking it to be extended but until the year end. Only 14% said no, and only 10% said let the banks decide. So it shows you that there is a demand for this. So Rajen, let's talk about then the better money management. All right, how do you see this changing, and what kind of lessons should we be learning from the pandemic based on just money management in this regard?
Okay, let me begin to answer that by giving you an example that is incredibly close to home. In the dim and distant past, I had a career with different companies as a conventional employee. Usually at those jobs, I was paid once a month, but for some of my jobs in the UK, I was paid per week. And for one job in Malaysia, I was actually paid twice a month. Very long time ago. I'm going back 30 years now. But I've been pretty much on my own for about 25 years, self-employed. And I just want to let you know, March 16th was when the announcement came out about the MCO starting in Malaysia on March 18th. So it's less than half a month as far as March is concerned. The bulk of my income, I actually lock in the first week of the following month. So half of March was affected, and I saw a drop in income in early April. And then I saw another drop in income in early May, and then in early June, basically for the months of March, April, and May. Obviously, there's no confidentiality here because I'm talking about myself. So my clients can rest easy. But in those 3 months, I personally have seen a 68% drop in income. And the reason that I am calm is because I had actually set my reserves in place, and I was very thankful for that. Also, it helps that I'm old enough, so if I really need to, I can tap into EPF without having to say, please, sir, let there be some kind of special deal. But the way to move forward is this. With regard to buffering, what this particular crisis has taught me is that the principles that, Linnet, as CEO of FPAM, and my colleagues, my peers who are licensed financial planners throughout Malaysia, the message that we have consistently put across is that you need to assume that life's going to throw some wrenches at you. And that is why you need to have a cushion account or a buffer account, an emergency buffer fund, a reserve account. And nothing that has happened throughout this pandemic has caused me to need to change any of the guidelines with regard to employees or those who are self-employed. You can Google my name, you can Google emergency buffer fund, and you'll find that the advice has been consistent for the last 5 years, last 10 years, last 15 years. Nothing's changed. The principles hold. And the principles are, you have an emergency buffer fund, and it is cash that you own. I learned this lesson very painfully during the Asian financial crisis 22 years ago. I had an overdraft account with Standard Chartered Bank, and it was 100% secured. In other words, I think it was like a 50,000 ringgit OD against a 50,000 ringgit FD. One would assume no risk whatsoever. But as the situation worsened, not just in Malaysia, but throughout Asia, the bank, from the perspective of its shareholders, very wisely decided 100% cover is not enough. And so they sent me a letter, which came at the worst possible time, saying, dear sir, we're terribly sorry, 100% cover is not enough. We need 105% cover. So I had to scramble. I was able to scramble and find more money and dump it into the bank and stuff. But that lesson 22 years ago, and by the way, I got married 22 years ago and bought a house. You can imagine how stressed I was with all this going on. That lesson left an indelible print on my brain that as useful as the banks are, ultimately their interests are their shareholders. And we have to take responsibility for ourselves. It's exactly the same thing with any government, not just the Malaysian government or the Singapore government or the US government. Every single government puts itself forward as saying, we have the interests of the people at heart. But the truth of the matter is the responsibility is ours. And how do we begin to exercise that responsibility? We look at our net worth statement, we look at our cash flow statement. Based on the patterns that we see in our cash flow statement, cash in, cash out, from the cash inside, we end up with a particular number, that is our income. That becomes the top line item for our budget. What we need to do is have a written budget. This is so basic that many people listening are going to say, I know this already. Great. Do you do it? Or is it just in your head? I do this professionally. And throughout the MCO, with a 68% drop in my income, you can imagine I went over my budget again and again and again and again, trying to figure out how can I tighten. Having done that work, even as I expect my income to trough, to bottom out this month, and to start clambering up substantially in the months ahead, I don't want to lose those gains. So it basically decides how much more delayed gratification, how much more control can I actually exercise. So hopefully that gives you a general sense of what I'm trying to get at. Just one more thing about the emergency buffer. For an employee, the unchanged guidelines are you should have a 3 to 6 month emergency buffer. The money should not be in an overdraft account. The money should be yours, preferably in a bank savings account, in a series of fixed deposits. For the Bumiputras who are listening, I think you could be quite comfortable putting at least part of your buffer in an ASB account or ASB2 account, but somewhere where your focus is not your return on capital, but your return of capital. In other words, when you want the liquidity, it's going to be there. Do not rely wholly on a bank overdraft, because you may find that the rug is just yanked out from under you. This is going to make me very unpopular with the multiple bankers I deal with, but that's the truth. You got to take care of yourself and you got to stay strong. With regard to those of us who are self-employed, we need to have an emergency buffer of between 6 and 12 months expenses. And something that I have always toyed with at the back of my mind, but I've never articulated until this particular crisis, after watching restaurants shut down, hotels shut down, is to realize, we need to be very, very intentional for those of us who run our own businesses to make sure that we are super, super cashed up. To take the view that, we don't know what the future holds and what will happen if my business, my company revenue drops to 0 for 3 months, if it drops to 0 for 6 months, if it drops to 0 for a year. And if in the recovery period to come, we are able to build our surpluses, keep it as retained earnings, let's say, in your company, and get to the point where we've got 12 to 24 months of expenses. Under normal circumstances, people will say, you're sterilizing your money, you're not growing your money. That may be so. But when a crisis comes, if you're not holding any debt and you've got a pile of cash and all your competitors around you are actually falling apart, you can sit tight, you can retain all your people, you can maintain their salaries, and this is very important, you can cherry pick the retrenched employees of your competitors and you can get the best people in. This is how you thrive through from cycle to cycle to cycle. It's not an accident that Warren Buffett's sitting on more than $100 billion in excess cash. A couple of years ago, he got to the point where he was saying he simply couldn't find anything to invest in. And having that cash in this environment makes very good sense. Roshan, sorry, I kept going too long.
No worries, Rajen. Linnet, do you, on this point, actually, I'd love to hear from you as well, in terms of the savings behavior that you would like to see going forward. I think Rajen very clearly emphasized the point that it's important to have those cash buffer. And essentially, it's very important to pay attention to how much you can save, expenses being the key crux there. What is your view on the matter?
And I totally agree with what Rajen has said. In fact, just a little bit, since he's sharing experiences a bit closer to home, allow me to do so as well. I have a staff who's looking to buy a car, and he has been saving up for a car, and we told him don't buy yet. He got his bonus and he kept it. And recently, with the announcement of the breaks that they have in terms of, I think it is for cars, it is, I think, no tax or something like that. Now he's happily shopping for a car. Now, if he did not have that saving, and this is not emergency saving, this is his saving, particularly to replace the car that he's driving, he would not have this opportunity. So having savings is very important, and a lot more closer to home. FPAM actually has reserves. And why do we have reserves? Hey, we are a financial planning company association. If we don't walk our talk, we will not. We will be failing our. We will fail ourselves as an association. So we have this buffer, and when the MCO happened, we were still able to pay our staff salary. We did not need to cut anyone. And whilst our buffer is helping us, we are actually scrambling to convert our business to, or rather our activities to be online. And that's why one of the things that came to my mind is that if anyone wants to start a company, gone are those days where you just look at capital, you save enough for your capital. You probably want to put aside money for emergency funding as well, in addition to your capital, because learning the lesson from the startups today who start out just before the MCO, a lot of them are actually a casualty because they did not have that buffer. And I feel so sorry for them as well. So on that note, echoing what Rajen says, we can't stress enough on savings as well as savings for emergency. Savings is because when you have goals that you want in life, you have this opportunity when investments are on sale, so to speak, you can actually take advantage of that with your savings. So yeah, over to you, Roshan.
Thank you, Linnet. Malek, do you have any of your own anecdotes you'd like to add here before we move on to talking about investments?
So I'm unmuting myself, sorry. I just, actually, for me, it's more, I guess I like to throw forward a question. A person called Jack Runner will come over and talk about basically a few questions. But I completely agree with what Rajen is saying and Linnet saying about this cash buffer. Cash buffer is really important. And I think that's been, and interestingly, as a business, it is, I remember there's an opportunity, sometimes when you're a business owner, there's an opportunity to run the business in a way like slightly on a knife's edge, right? Basically, you dividend out profits to shareholders and employees, etc. And then you kind of like operate on a sort of like a 3-month level, etc. Right? A 3-month cash expenses level. For us, it was very, very fortunate. I think very, very fortunate that we at BFM, for example, we kept a 6-month buffer for the business. And then even with that 6-month buffer, we implemented things that will reduce our cash outflow. I mean, all of us took a pay waiver, right? Meaning for until we pay deferment. So the things that we can do. But the fact that makes me sleep at night as comfortably is the fact that we had that buffer in the first place. And and I think maybe it was I always in my mind 3 months buffer cukup lah. It's like 3 months is enough. But somehow I was always very reluctant to sort of dividend it out until it's 3 months. I always felt like I like the security of having that 6 months. And then I guess it kind of like that sort of insecurity, this indelible print that Rajen talked about, which I suffered through at the same time. 1997 Asian financial crisis is somewhere in there. It's always at the back of our minds, and it's like it's left such a big impression that it's almost psychologically difficult to have anything less than 6 months buffer in any companies that I run, right? That's actually, if you ever get to that situation now, yeah. So
I do actually want to spend just a minute on that. So as someone who just turned 30 this year, I've never really been through a financial crisis of my own, right? So to me, the economy has always been, or more or less, has been very booming in most ways, especially the last 10 years. And I've always been on the fact, oh no, you need to put your money to work. You need to, you maintain a certain small amount of cash, and then the rest of it, you got to put it to work, you got to put it to work, you got to put it to work. This, however, this I can personally say has changed the way I think about having a cash reserve, and not just for me, but for a lot of my friends in this age bracket, because it's the first real crisis we've been through. When we know people who've lost jobs, we have friends in hospitality, we have friends in aviation who no longer have incomes. And that's the indelible ink that you want to retain. That's the painful lesson that's going to come from this, from the last 10 years of easy money, is that when it's, for those who it's easy to get easy money, that's fine. But for the rest of us, when the income stops, it's going to be very hard. And that's why you need a cash reserve. It's I think, Rajen, we've talked about this, how it's one of the most important things that you can have. Now, if you've just joined us though, today we're talking about what lessons are there to learn from the MCO, from the pandemic, as we move forward from these painful lessons that we've had to learn. And this BFM Personal Finance webinar is brought to you in collaboration with the Financial Planning Association of Malaysia. And coincidentally, today we have Linnet Lee, CEO of FPAM, joining us on this panel discussion, alongside Rajen Devadason, CEO of RD WealthCreation. Co-moderating this with me, as always, Malek Ali, founder of filife and BFM Radio. So right now, let's pivot over to investing. I think this has taken a lot, it's gotten a lot of attention in the last few months. I mean, look at any stock graph and you'll see the middle of March, just a giant crater there. And then you see the Fed turn on taps and immediately the stock market, not just in the US, but around the world, starts rocketing back. I think the NASDAQ is past its all-time high again. Rajen, when we look at this, at the investing opportunities out there, on the back of things like the rates that have been cut, the stock market, the way it is, the volumes that we're seeing as well, what are some of the things that you're paying attention to at this point? Some things that we can maybe learn from the last few months?
In my opinion, the markets have not dropped nearly far enough to reflect the massive deterioration in the global economy. I will be very happy if the markets collapse. I am in a minority in that regard, because when I deal with my friends who are also in the community, they get very excited when share prices are rising, and everyone's talking about the Malaysian glove makers. But I think that once you have put your house in order, investing should be a lifetime activity. And the older you get, the more important investing for yield becomes, and the less prudent it is for you to try and go for a quick capital gains shot. Having said that, there's always the thrill of the chase. Now, none of us knows what's going to happen tomorrow, but we are capable of making some fairly intelligent guesses. My guess, number one, is that things in the real economy will get worse before they get better. Number two, because things will get worse, central bankers that still have some runway, in other words, positive interest differential capabilities, they are the ones who are actually going to say, okay, fine, let's cut interest rates some more. So in a world where we generally can't predict interest rate movements, right now, I think we can, down. And with interest rates going down, you got to look at the investment scenario. And, I sincerely believe that we should never put all our eggs in one basket. My late mother taught me that a long time ago, and I have never forgotten. Don't put all your eggs in one basket. In investment parlance, it means diversification. I believe three dimensions of diversification are essential. Diversification by asset class, diversification by geographic region, and diversification along a very long timeline. Because I'm going to land and roost on the asset allocation, let me deal with the other two bits first. Geographic diversification simply means you're going to spread as much as you possibly can across the world. Don't put all your money in Malaysia, don't put all your money in Singapore, don't put all your money in China, don't put all your money in Australia, don't put all your money in the US. Everywhere, spread it as much as you possibly can. With regard to diversifying across a long timeline, I would recommend utilizing either dollar cost averaging or value cost averaging. We don't have time to go into all that stuff, but many years ago, I actually created a learning resource. So anyone who Googles my name and just dollar cost averaging, value cost averaging, you should be able to find a link to some free resources there. Now, when we talk about asset allocation, the World Wealth Report, published once a year by wealth management company Capgemini, does consistent research most years. And it actually specifies that the world's wealthiest people, not the super billionaires, not the 2,000 people who have more than $1 billion US net worth, but, you know, regular rich people, people who have at least $1 million US investable. So without pointing out anyone, there are people on this call who already qualify there. I'm not looking at Malek, but, you know. So right now, with regard to that World Wealth Report, the 5 asset classes that the study dissects the allocations into are cash, fixed income, meaning bonds, equities, meaning stocks, investment real estate, which I think can mean brick and mortar if you don't live there, if you're collecting rent, as well as direct REITs, as well as REIT funds, REIT, real estate investment trusts. And then, of course, you've got alternative investments, things like derivatives, which Warren Buffett has referred to as toxic weapons of mass destruction. PE, in this case, not price earnings ratio, but private equity, structured products, whole bunch of other things. But my favorite within the AI space, alternative investment space, is commodities. So if I build a vastly diversified portfolio for my clients, I will use cash, meaning money market funds. I will use equities, meaning domestic and international equities. I will use, I jumped ahead of myself, the bond side of things. So basically bond funds, then the REITs as in REIT funds, and then commodities as in a commodity fund. Now, coming back to interest rates, if interest rates rise, let's say, we know that from an investment and a mathematical perspective, when interest rates rise, bond prices fall and REITs fall. And REITs have a higher risk premium than bonds. So typically REITs will fall more than bonds. But right now we know that interest rates are falling. They have fallen, and to the extent that they can still fall, because lots of places are already negative, which is a terrifying situation. But, you know, throughout emerging Asia, for instance, we've got positive rates. As rates are cut further, it is fair to assume that bonds and REITs will go up. So you may be able to lock in supernormal profits for much lower than normal risk in those two asset classes. Does that answer your question, Roshan?
Yeah, I think we're basically getting that that picture, especially on the back of the interest rate cuts, right? How that relates to the rest of investing, and really why we're seeing more money sloshing around as well. I think that's part of the reason why the equity markets have also done quite well there, essentially. We have actually a question here from John Hugh. Do you recommend to lower a mortgage loan or go for investment? I think this is a very interesting question here, right? So if you've got your emergency buffer fund sorted, as John Hugh has mentioned here, do you take that extra money that you have, buffer fund aside, do you pay down your mortgage or do you invest it? I think this is a simple question of opportunity cost, but not so easy to answer. Linnet, before I get to your views on investing overall, Rajen, maybe we could address this.
Okay, answering John's question. If John's house is in order, he's not carrying consumer debt, and we're only talking about a mortgage, and he's comfortable paying his mortgage, then I would say, yeah, by all means, go right ahead and invest, but don't invest aggressively. Invest gradually. Like I said, diversification across a very long timeline. There will be opportunities, and for those who feel that they understand markets better than others, a lot of money can be made. So yes, I would say if your house is in order, if you're not carrying an excessive amount of debt, I would say yes, by all means, start investing, continue investing, and continue to do so in an opportunistic way. However, many people listening here will say that, okay, I've got money on standby, I've got lots of debts, including credit card debt that's not being paid off, etc. And for people like that, I would say, please, please, I beg of you, don't go chasing after the leprechaun's pot of gold at the end of the rainbow, when you have the opportunity to actually generate a risk-free return of between 15 and 20% just by paying down the outstanding balance on your credit cards. And in this market, there is nothing in the investment scenario, normal investments, that will give you anything close to 15%. Most of us who, 10, 20 years ago, we were quite comfortable tracking and projecting long-term returns for our clients in the 10 to 12% range. Even as global interest rates have come down, and even as the expected returns from other investments, which would be risk-free rate plus risk premium, as the risk-free rate, the cash rate comes down, the premium stays the same, but the returns that you're getting will drop. So our expectations have fallen as well. And so it requires a great deal of education, because clients will say, you guys are lying. And no, we weren't lying. The environment changed. And licensed financial planners in particular, I think, to the right people in the Malaysian community, are able to actually take you through a historical journey to help you try and understand this environment we're in now will improve. How do we know this? Because we have the vast sweep of history to teach us. But there are certain aspects of the global economy that are changing, that are continuing to evolve. My financial planning principal company is Manulife Investment Management Malaysia Berhad. The house view for Manulife globally right now is a phrase that I keep using almost every other day with my clients. Lower for longer. Lower for longer. That we're looking at lower interest rates for a much longer time. And therefore, on the plus side, it means that we are able to pay lower interest rates on our loans. But when we consider the kind of stresses that people underwent at the beginning of this pandemic crisis, when we look at the full sweep of history and we consider all the past crises, including, let's say, the Great Depression from 1929 to more or less 1939, the OPEC crisis, the oil crisis of 1973, the commodity crisis of the mid-80s, the Asian financial crisis of 98. I can go on and on and on. The global financial crisis, which started in the third quarter of 2007, but was really felt in 2008, 2009. This particular big crisis, and, listen to me, and the crisis to come, and the crises to come. In other words, the next crisis, and the one after that, and the one after that, and the one after that. Now, whether the next crisis hits us in 5 years or 10 years is immaterial. It will come. This crisis will end. Things will improve. The people who enter the very next crisis with a large emergency buffer for themselves, for their families, for their business entities, and who are carrying zero or at least very, very low debt, these are the people who will be in the best position of all to prosper at the beginning and the depths of the next crisis. I hope that helps.
Linnet, do you have anything to add to that before we move into a bit of a talk about currency? There's a question that's coming on that.
Yes, before we move into currency, I caught a question that was asked by someone who said that because it's a premium holiday on his investment-linked insurance, and he asked whether he should take that holiday and use his premium money to invest. So to me, you need to be very clear what you are using your money for. And this is where money management comes in. If your intention is for you to use that money to pay for your premium as a protection, please do not mix it with your investment money. Main reason is because, yes, there may be a premium holiday. And I think we stressed that in the first series of webinar we started. Do not stop paying for your premium. You should continue, especially if you do not have a cash flow problem. Why? Even more so during an investment-linked policy, because you must remember, every time when you put in money, a portion of it goes into units, and the units will then be able to use as in lieu of your cash value. So if this money that you have to pay a premium, you should continue to pay, because it's going to help you to accumulate so that later on you do not need to pay so much in terms of premium for your policy, number one. Number two, that premium that you pay will be accumulating units at a lower rate. that is also, in a way, you're also taking care of it, of your protection. So I can't stress enough, protection money, keep it there for your protection. Do not mix it with your investment. If you have spare cash to invest, by all means do so. So I hope that answers the question of the person who asked. In terms of, yeah, sorry, go ahead, Roshan.
No, it's Lina. I think that just balances out very nicely, right? Separating between growth and protection. These are two things that you shouldn't be mixing together. Essentially, one is to protect what you have now. The other is to grow what could be for your retirement, for your education goals, for all the other things that you may have plans for. And it really comes down to your wants, right? Lena, I think that's the goals there that you pointed out. That's very important, because it's very easy to take opportunity. Oh, loan moratorium, I've got excess cash now. Oh, take this the moratorium, I've got excess cash here. And then you without a plan, you start allocating it all over the place. And that just feels very messy and can lead to trouble, because if you're investing without a goal, you don't know when to exit. You don't know when to how long to leave it. It can get, and I'm speaking here from personal experience. When I've invested without a goal, it's very anxiety riddling, because you're not sure why you're doing it. Rajen, let's talk about currencies right now. So Harry Chung has got a question here about emergency cash buffer. And he's asking about, do you keep it in a mix of currencies or do you keep it in one currency? What are your thoughts on this?
Harry, that's a fantastic question. I think if your expenditure profile involves a mix of currencies, then it makes very, very good sense for you to have your buffer in different currencies. Those of us who are Malaysian and have lived long enough to have been Malaysians for decades, at the back of our minds, we have actually clicked the various Malaysian ringgit, Sing dollar exchange rates. I am old enough to remember 1 to 1 and 1 to 110. And I remember when I worked for a magazine called Smart Investor in Singapore before I came back to be the founding editor of Smart Investor Malaysia a very long time ago. At that time, when I was in Singapore and I was earning in Sing dollars, I was very excited because I was earning 1.8. Now, 1.8 is difficult to calculate. Then I realized all I got to do is double and subtract 10%. That's how I end up. So if I get paid 5,000 Sing, double becomes 10,000 ringgit minus 10% of that, and it drops to 180. Right now, of course, the exchange rate is 3. So when you take when you accept the reality that the Malaysian ringgit has been on a long-term slide for a very long time, and when you look at everything that's going on right now in the political arena in terms of genuine leadership, it is not unreasonable, I think, to assume that we're not going to end up becoming the strongest currency in the world. Therefore, for an individual who has all of his expenses in Malaysia, by all means, keep your buffer in ringgit. If you got business expenses or personal expenses in the US or in the UK or whatever else, yeah, by all means, have other currencies as well. It's a very, very good question. Well done.
All right. Linnet, do you have anything to add to that before we move on? There are a few other questions coming in, actually. And if you have any questions, do let us know in the Facebook comments. We will try to get to them. Linnet?
Yeah. I think we were talking about investments and we're talking about, am I jumping the gun? We are talking about also trading as well.
Yes, actually, this is something that we've noticed, right? We're seeing a lot of retail market activity, whether it's not just Bursa Malaysia, but in the US markets as well. What are your thoughts on that?
Well, during the MCO, people who are bored stiff staying at home, but have been dabbling in share market, I saw their heightened activity in shorting the market because there were plenty of opportunity to take advantage of the differences in pricing. But it has also made prices of stocks go up and down, yo-yoing. And as a result of that, recently Bursa has put out a notice to stop margin trading until end of the year. I think normal trading will be good, it's healthy, but when there's unusual or abnormal activity, it makes perfect sense to do that. This was something that is a side effect of the MCO. Yeah. So I would say that if you want to invest in stocks to take advantage of the low prices, by all means. But if you are doing this in terms of playing with the prices, I think that's not good. one should stop doing that. You can get burned as well.
I think that's very important to remember that when you invest, there is risk, right? That there's always an opportunity. There's always the possibility that you could lose money from it. Not all stocks are created equal. Not all perform the same way. And just because the overall market is going up doesn't mean that the stock that you're investing in is going to follow that trend. I think a lot of times people like to, I guess the proper word here is play. They like to play the penny stocks because half cent move up is maybe 10%, 15%, 20%. But remember, if it goes down half a cent, that's also 20%, 15%, 10% down. Rajen, we've got a question here from Daniel talking about, I think related a bit to what we were talking about debt earlier. So his question is, banks are now calling home loan account holders, offering redraws of their loans here. So do you think it's worthwhile to use this money to pay off retail debts, credit cards? We addressed this a little bit more here, but maybe you could go directly to Daniel's question.
My short answer is, for most people, no. Even though the interest charged on your housing loan is much less than on all retail loans, the majority of people who take advantage of this facility out of desperation find that, after being harassed by credit card companies for years, they have some kind of home loan extension that's granted to them. They've got money in their pocket. There's a tremendous sense of relief. And they pay down their credit cards, and so the balances drop to zero. But they don't alter their behavior. So what's happened is, let's say they pulled 50,000 ringgit. Okay, let's say they owe 300,000 ringgit on a mortgage. And they have, in the past, paid down maybe 100,000, and the bank says, would you like to redraw 50,000? So then what happens is their loan goes from 300,000 to 350,000. It's still at home mortgage rate. So from an interest rate differential, it makes sense. But in terms of behavioral finance, what happens is the 50,000 goes to pay down the credit cards. Most people who do this do not destroy their credit cards. What they have are fresh credit cards and go shopping again. And in the vast majority of cases, it does happen. And within a year, their credit cards are maxed out and they owe more on their housing loan. So sorry, if I may just continue.
Yeah.
When I say this, I am not speaking from a position of strength or even from some pundit in an ivory tower. I got into personal credit card problems in the 1980s in the UK. I had to come back to Malaysia in October '89, secure my initial jobs in 1990 in Malaysia, convert, we were talking about weak ringgit, right? I had to convert ringgit to sterling, send it back to my bank in London and pay down my credit card slowly. It took me years. I did it. I was very happy, but I'm a slow learner. As a result of that, I got into credit card problems in Malaysia. It took a shorter time to dig myself out of that because the loans there were denominated in ringgit. I was earning in ringgit. So I'm not giving advice basically from a theoretical perspective. I know what it's like to be under so much pressure that you lie in bed at night being unable to sleep. And in your mind's eye, you are thinking, okay, how do I keep this house of cards up? Or if I'm juggling many balls, how do I keep everything running? How do I borrow from Peter to pay Paul? And so in the long run, the only solution is for us to start a debt eradication program. The best one I know of, I call small to large. The Americans tend to call it the debt snowball. And the way to do it is you list all your debts from smallest total outstanding to second to third to fourth. You make your minimum payments early, not just on the dot, but early for all of them. You squeeze out from the excess cash that you have in your budget because you built a surplus, and you use part of that surplus to target the largest loan, make it disappear. Once it's gone, go and celebrate. Celebrate in a cheap manner, but celebrate. And then you take the minimum payment on that smallest loan, plus the minimum payment on the second smallest loan, plus the surplus that you already generated, and you attack the second smallest. So that's how you eliminate it. So in general, my advice to Daniel is no, don't take the redraw. But there are some people who are on the verge of collapse. You know, someone's going to make them a bankrupt if they don't fix this quickly. And if you are at that point of desperation, yes, because it's there, take advantage of it, but get very, very serious about getting out of debt as fast as you can.
Right. So Rajen, essentially, it's there's no point trying to chase that better interest rate or how to eliminate those things if you don't change your habits and you end up spending the same amount of money, right? If you don't change the behavior, you end up in the same problem, and all that effort you spent is really wasted.
You're actually worse off.
You're worse off because you would have paid extra, or you would have redrawn more money. You're in more debt overall. So it's very important to you got to eliminate those habits. You can do all the actions, you can take the loan moratorium and all these things, but if you don't utilize the tools and the all these infrastructure that's provided, then you could end up in a worse situation. Just before we move into the last part of this webinar, I just want to remind everyone that, and welcome those who've just joined us to this BFM Personal Finance webinar in collaboration with the Financial Planning Association of Malaysia. Today, we're looking at how to move forward from the pandemic and the MCO lessons, the painful lessons that have been learned, and how to maybe prepare going forward. Joining me today, Rajen Devadason, CEO of RD WealthCreation, and Linnet Lee, CEO of FPAM, joining us, gracing us with her presence today. Linnet, we were talking about the debt situation, whether you should draw down more money. When it comes to some of the lessons here, we've covered quite a bit of ground here. Is there anything that you personally want to highlight in the last 10 minutes of this webinar?
Yes, thank you, Roshan. And one of the things that is most important is ourselves. And I would like to talk about job opportunities. With the MCO, we saw a lot of jobs disappearing or on hold. Airlines, tourism, and I believe in one of the sessions that was shared by Lin Hui Hui, she said that a tourist guide was very smart. He went and did real estate instead because he found that he has the gift of the gap, but because tourism is not going to get anywhere, therefore he has actually transformed himself to be a real estate agent because he could talk and he can continue. So these are things that we need to look at. What do we see moving forward, especially if there are more crises to come? Jobs that will be quite resilient will be those in terms of advice, those in terms of services. The other thing that caught my attention was that someone who has a hobby playing with drones. And what happened was when the crisis came, he actually rented out his drone and he could make a few thousand ringgit just by using his drone, renting it out to someone who wanted to continue working, taking photographs and all those topography photographs. So I think one of the things that we can do, we can talk about investment, we're talking about paying on debts, but the most important thing is, are you able to continue earning an income? And if you don't with your current job, you need to think how you can reinvest yourself. And nowadays, I also realize people are not hiring just on paper qualification. One of the things they are hiring on is number one, your experience. Number two, what is in your head. There's no point having fantastic degrees, but nothing is retained and you can't implement what you have learned. So I have seen people without much paper qualification, but they get very far in their profession. The reason being that they implement what they have learned and they learn more. So I can't stress enough that you should learn more. There are so many online learnings and some of them are free. Some of them come from very reliable sources and they're not expensive. They're really cheap, 10, 13 US dollars. I only wish I have time to go back and study. I would if I could. I love studying because information that you learn, you will be able to use, it'll add value to you and you'll be able to continue to earn a living. And whatever that we discuss here today, you'll be able to implement.
Yeah, I think on this note, I would like to encourage everyone to take a look at MDEC has a relationship with Coursera, and there are plenty of courses available for free for those who are unemployed. So take a look at that. Also, you want to take a look at your EIS, the benefits that you can get there. I know some people personally who've lost their jobs, and EIS can keep you afloat for a little while and encourage you to do that through the job search allowance, things like that. So please look all these things up. There are options at your disposal, especially if you've been recently laid off. And while we're talking about income, actually, with the 5 minutes left in this webinar, I'd like to remind everyone that today is the last day to file your taxes, e-filing. It's your civil duty to contribute to the coffers of the government, especially during this very pressing time. And I think, Rajen, when we were talking about this before the show, you've got a method that you want to share in particular to this. Now, give us 5 minutes and then open up the LHDN website to pay your taxes. We're almost done here. Rajen, what are your thoughts on this?
Okay, basically, I have found that over the years, while I have never been late with a tax payment, very often when the numbers come in and I end up having to pay more taxes, which usually happens, more taxes than expected on a year-to-year basis, I find it very stressful. And many years ago, I finally decided, this is ridiculous. I just don't need the stress. So for myself first, and then subsequently when I started advising clients, I think it actually makes sense for us to actually put in place a sinking fund that will allow us to have excess money just before tax payments are due. For those of you who are conventional employees, you already have your, what's it called? The PCB deductions, right?
PCB.
Your steady deductions. But a lot of people basically don't end up with tax refunds. They find, oh no, I got to pay the tax department more. So after a couple of years of this, you generally get a sense of what percentage of your gross annual salary is usually due. And let's, for argument's sake, let's say it's 6% of your gross annual salary. That is the top up that's required. If that's the case, you would be quite wise to actually put in place a sinking fund for your taxes of between 0.5 and 0.75% of your monthly income, just to let it build up. Oh, sorry, of your annual income, to let it build up. Which also means then you take about 6 to 9% of your monthly income and you set it there as separate savings. If the government doesn't come a-calling and say, give us more money, the money is yours. There's no risk in having extra savings. And for those of us who are in business, and because we tend to keep all our money and then we file our returns and then we've got payments to make. Usually for those of us in business, the government's very kind. They give us a year to pay, and it's like 6 payments and it's every 2 months. I've got very little time for this. So ever since I started putting together a sinking fund, I have instructed my accountants to tell me the full sum. I don't want to think about this. I've got the money, I'll just pay it. Now then you may say, oh no, but it's very bad utilization of money. You should put it in your fixed deposits, earn interest. I don't need this. I need the stress removed so that I can focus on my business and making money. I found that people who keep trying to juggle everything up in the air, trying to make the maximum amount of money, typically they fall at the very last meter, and they end up being hit with fees and whatever else. So having a sinking fund for your taxes, I think, is very wise.
All right, and Linnet, do you have any advice here when it comes to tax planning and paying as we wrap up this BFM webinar?
I think for those who need a little bit of help, they may want to circle back to FB Live recordings that we have done in the past. We had a session with Yiling and I think it's Felix on taxes. Please go back and look at that before you file your taxes, because we want to make sure that you take maximum advantage of the tax breaks that you have. And always remember, tax avoidance is better than tax evasion. Tax evasion is illegal. You get fined and you may land in jail. All right. So with that, thank you so much.
All right, Linnet, thank you. And I just remind everyone, today is the last day to do your e-filing, which means it's pretty much the last day for you to pay your taxes. And it's something, we've been given, I think, a 2-3 month extension, April, yep, about a 2-3 month extension. Get it done today. In fact, right after this webinar, just open up a new tab, LHDN, sort it out. Thank you, Rajen. Thank you, Linnet, for joining me today. Thank you, Malek, for joining us. I'm not sure where you went, but definitely your banter was very much missed. Now, don't forget that just the webinars are not over. Later this week, we've got a Building Sustainable Businesses webinar with our colleagues over from Enterprise. That's happening this Thursday, July 2nd at 1:30 p.m. with the Managing Director of Lala Move, Shen Ong, as well as Alpro Pharmacy and Maybank Vice President for Digital Partnerships, Kenneth Lim, and Alpro Pharmacy Marketing Director, Lee Yin Chen. So a very diverse group there to really talk about how to move forward from this and like the title suggests, building sustainable businesses. On that note, thank you all for joining us for this personal finance webinar. My name is Roshan, the producer and presenter for Ringgit and Sense. Today, I was joined by Linnet Lee, CEO of the Financial Planning Association of Malaysia, and Rajen Devadason, CEO of RD WealthCreation. Thank you all for your time and have a great week ahead.
Thank you so much. Bye-bye.